Welcome to this episode of Financial Nonsense, 2nd of June 2016. I'm Aaron First. There are so many silly financial concepts and theories promoted by the financial industry, and in this article I'm going to cover one of them. You may wonder why I've used a haunted house in the thumbnail image, because if you apply this financial theory to your portfolio, your returns will be ghost-like. The author of this article writes about the 5 principles for strategic investment planning. Principle number 1 is to diversify your portfolio. Principle number 2, diversify your portfolio. Principle number 3, add a third layer of diversification. Principle number 4, plan for lower returns. Yeah, that goes without saying if you're going to diversify so much. And principle number 5, never forget the first 3 principles. Now, unfortunately for investors, the financial theory of diversification is heavily promoted within the financial planning industry. I use the word unfortunately because in the pursuit of managing risk by spreading your investment capital across a broad range of uncorrelated asset classes, your investment returns are also mitigated by spreading your investment capital across a broad range of asset classes. The reality of diversification is that it is a stupid concept and it doesn't make sense. Why would you split your investment capital between 2 assets that move in opposite directions? When one asset achieves returns, the other asset loses. So the net result is negation. And it's not your financial planner's fault. They're trained in the art of mitigating risk, not in the art of achieving returns. The reality is they derive their income from commissions and from consulting fees. When it comes to long-term investing is about harnessing the power of compound interest. So I would suggest aggressively searching out market analysts that have a proven track record in understanding economic cycles. Analysts that are confident in weighting your portfolio heavily towards a stock allocation in an economic expansion and then rebalancing that weighting towards a complete bond allocation in a contracting economic environment. To summarize this article, it promotes diversification not only on 1 count, but on 3 counts, which is absolute craziness. It's like a game of tug of war inside your investment portfolio. And at the end of the day, your returns will suffer when your portfolio is at war with itself. Warren Buffett has even said diversification is protection against ignorance, protection against a lack of knowledge. Forget technical analysis, forget fundamental analysis. If you want to become an outstanding long-term investor, it's economic analysis that must be mastered. And then fundamental analysis and technical analysis can be applied on top of that solid foundation of economic analysis. The financial theory of diversification is nonsense. Find an analyst who will place your investment capital into assets that move in alignment with the economic cycles. There's plenty of qualified analysts out there. I don't have much more to say on the subject. Good luck with your investing, and we'll talk soon.